in 40-45 minutes. I want to wind it up in 40-45 minutes. So we'll straight away get to the point and get started. As people join, they'll listen from wherever they join. We are talking about perspective to look at the markets. It is not market outlook. I just want to give you a lens to look at the market. Last year, if you all remember, we were quite bearish on the markets. We were one of the most bearish voice on the markets in 2024. And today, we are probably one of the most bullish voices on the markets right now. So why did we change our opinion so much for 180 degree? The correction was there, but still, the market has again gone back to the same level. But still, we hold a very bullish view on the markets. So we are trying to explain you why we've changed our view so dramatically. The flow of presentation is such that we're going to talk about one big macro change which is underway. How micros have changed in the how the constitution of the index, quality of the companies and everything has changed. Quality of the promoter has changed at the core company or index level. We'll talk about liquidity. We'll talk about this. We'll indulge into this large cap versus small cap debate. Then we'll touch upon see last 5 years the investment and capex team has done better than consumption theme. So we'll look at how things stack up over the next few years, and I'll at the end I'll give you a short-term market view. So starting with macro view, I'll run this slides fast because I think we have already shared some of these through WhatsApp broadcast. So fiscal deficit is the gap between government's expenditure and income. Typically, for a developed country like India, it always is high. For I think most countries, it is there is a fiscal deficit, and for a extended period of time, it was between 3 to 4%. But when the COVID happened, the fiscal deficit rose as high as 9.2%. So because of that. It was as good as saying that a home loan was running, but then suddenly somebody had to take a personal loan because there was a personal emergency in the family. In the last 4 years, government had to pay the home loan or EMI also and the personal loan EMI also. But good thing is that they have run down the personal loan, so to say, and now things are much more normalized. If you see the fiscal deficit, they have cut it down by close to 5% in last 5 years. And it is expected that from 25, 26 to 30, 31, the next 5 years, the fiscal deficit is going to go down by only 0.9%. So government will have close to 3 lakh crores extra money in their hands just because they don't have to cut fiscal deficit aggressively. So 3.5 lakh crores of additional money government is going to have, which they can use it wherever they want, to boost manufacturing, to boost consumption, or anything that they want to do, they can do it through this. Second, the big macro change which is underway is that our currency is becoming very stable. Our currency, rupee, used to dance to the tunes of whatever happened to the oil prices. Whenever oil prices shot up above 80, 90, $100, our currency used to see a very massive bout of volatility and depreciation. So there are the past experiences in 2008 when dollar oil touched 135. Rupee had depreciated by 34%. Then there were other occasions in 2011 and 2013 when it depreciated close to 30%. In 2018, when oil went to $85, it depreciated by 17%. Around COVID time, it depreciated by 13%. And after Russia Ukraine war, it depreciated by 12%. In the last bout of volatility, where if I sold something like 2.5, 3 lakh crores, the depreciation was mere 6%. So between 2008 and 2013, there was a 75% depreciation. In the last 12 years, the currency has become extremely stable and the bouts of volatility also have reduced. The reason for that is that our current account deficit has come under control. What is current account deficit? It is the difference between countries' export and import. we import much more than we export, which is why we are in a current account deficit. So if you see, the current account deficit was very high between 2008 to 2012-13 period, which is why our currency had faced a lot of pressure. So because we were importing so much more than we were exporting, our currency faced a lot of tailwinds. Uh, so that time also, if you remember, oil prices were almost $100 for quite some time. So what has changed in the last few years is that the imbalance between import and export is kind of changing. The two biggest import items for India have been oil and electronic goods. If you see, 5 years back, we used to import $92 billion of oil and $50 billion of electronic goods. And slowly it has gone up. In 2023-24, we imported some $121 billion of oil and $76 billion of electronic goods, which is both put together close to $200 billion. And in the same period, IT services exports, which used to be 95 billion in 2019-20, it has risen to as high as $200 billion. And along with this, GCC, which was non-existent, or it was there, but it was very small piece. Now that has also become $64 billion in the last 5 years. It is estimated that in the next 5 years, IT services export will rise to $350 billion, and GCC exports will rise to $110 billion. So both put together close to more than $400 billion, and this is all growing only what do you say, at 8%, 10%, something like that, 7-8%, because our economy is booming, or the demand is increasing. Because of that, it is growing at 8-10%, and this is growing at a much faster pace. So we have reached a point where IT services is able to counterbalance the big oil imports and electronic good imports. And going forward, there'll be a situation where we'll become current account surplus nation. So when we become, why are we talking about currency so much? Is because it has got an implication on inflation. India's long-term inflation rate has been about 7.4%. And last 10 years, that inflation rate has already come down to 5.04%. In the last 25 years, currency depreciation, rupee depreciation, USD INR depreciation has been around 3.5% per annum. And so the moot point is that 1.5 to 2% of the inflation can be attributed just to currency depreciation, because we import so much of our goods that 1.5 to 2% of the inflation can be attributed just to currency depreciation. So because currency is becoming so much stable, the inflation is expected to come down structurally. If the currency becomes structurally stable, inflation comes down structurally. Say, it's like past few years, the inflation band was, say, maybe 5% to 7%. That probably comes down to, say, 3% to 6%, something like that. And if the inflation structurally comes down, then interest rates also structurally come down. So interest rate band, if it was, say, 6% to 8% in the past few years, it probably comes down to, say, 4.5% to maybe 6% or 7%, something like that. Say 1.5-2% decrease in interest rate structurally, and that is what we have seen. RBI has cut interest rate very aggressively in the last 3 months. If interest rates go down, we see ki there'll be a big boom in consumption. There'll be a big boom in private sector capex, because there'll be a big boom in housing sector. There'll be big boom in automobile sector. Automobile and housing or real estate are two biggest sectors in India, and they're like feeder sectors to like hundreds of different industries. So if they do well, then the like it's a vicious circle, and the economy itself starts to do very well. So that is our macro thesis. We believe that interest rates are structurally headed down because inflation, because currency is getting stable. That is going to bring inflation structurally down, and that is going to result in interest rate being structurally lower than what they have been in the past 10, 20, 25 years. So that is about big macro view. Another implication of lower interest rate is that when interest rates are low, the PE ratio, you can assign a higher PE ratio for stock. So if interest rates go down by 150 to 100 basis points, the PE ratio that you can assign to a stock or a stock market or index, it can easily go up by 35%. For the same stock or for the same index, say if some index used to trade at, say, 20 PE multiple, Just because interest rates have come down by 150 to 100 basis point, you can probably now assign it a PE multiple of 26 or 27 times. So that is another big change, and we have to look at the market valuation in that context. That in 2012-13, the interest rates or the GSEC yield itself used to be 8-9%. That is now come down to 5.5-6%. So in that context, the PE ratio has to get re-rated. Now this is something that is on everybody's mind, and a lot of people, there's a diverse opinion or polarized opinion on this. Are small caps in bubble territory, or are small caps reasonably attractive? There are people who believe it, they are in bubble territory. There are people who believe they are reasonably valued. We were in the territory of we used to we were in a bearish camp till February or January, and from February onwards, we've shifted our camp, and we've changed our view on the market. So we want to talk about why we've changed our view in the about the market. So in the next few slides, we are going to talk about that. So there are this is a comparison of two large cap stocks, Hindustan Unilever and NTPC. Both have more or less similar market cap. And the lines that the chart that you see, right? This is the 10-year. This is the uh, uh, P ratio, last 10 years P ratio. The upward chart is for NTPC, lower chart is for Hindustan Unilever. In NTPC, you can see it is rarely traded above 15 PE multiple. And if you look at the HUL chart, it is rarely gone below 50 PE multiple in last 10 years. The median PE ratio for NTPC is 11, while the median PE ratio for Hindustan Unilever is 62. So why is there a gap of six times, almost 5.5, 6 times? Why HUL trades at 50p multiple, but NTPC trades at only 11p multiple? And it is never like NTPC is never going to 20, 30p multiple, and Hindustan Unilever is not going below 40, like it is not coming down to 40 or 30p multiple. Why is it like that? I will look at another example. This is Jubilant Foodwork. This is Jubilant. The upper chart is Jubilant Foodwork. Lower one is Vedanta. If you look at Jubilant Foodwork, from the time it got listed in 2010 till now, it has never gone below 50 PE multiple. And the 10-year median PE for Jubilant Foodwork is 90x. Whereas the 10-year PE multiple for Vedanta is just 8.1x. So why is there such a huge gap, almost 10 times gap? Why does Jubilant Foodwork trade at 10 times valuation of Vedanta? Why is it so? Why does Jubilant Foodwork, why does the PE never go below 50p? In 15 years, why it is not gone below 50p? So we'll look at the reason why it is like that. And the answer to our question about small cap valuation is in that, right? So P ratio is a function of a couple of things. Okay, if the nature of business is cyclical, right? So if in one year you make a 10,000 crore profit, next year you make 5,000 crore profit, third year you make 2,000 crore loss, again you make 25,000 crore profit, like that. So if the trajectory is wavered, it's a cyclical business. And if there's a steady growth, like you make a 5,000 crore profit, then next year you make 6,000 crore profit, then you make a 8,000 crore profit, then you make 9,000 crore profit, like that. If it's a steady growth rate, then it's a structural kind of a business. So market doesn't like cyclical business, so you don't get very high P multiple. That's why Vedanta it trades at 8p, NTPC trades at like 11p. Whereas structural stories like Hindustan Unilever or Jubilant Foodwork, they trade at 50 and 60p and 90p. Growth trend. So growth trend is the growth rate in single digit or is it in double digit? The higher the growth rate, higher the P multiple that you get. Growth longevity or something like say railways or defense, right? Defense to find I think, but in case of railways, like the capex is not going to last permanently. Once that capex is done in next few years, then the capex will not come again. Even capital goods stocks also, it is not like a perpetual growth story. As compared to that, something like a Jubilant Foodwork, the Domino's Pizza or KFC and all, the growth rates is very, very long because they're doing only a few thousand crores of turnover in a country which has got 150 billion dollar, 150 billion people. So growth longevity, the more higher the growth longevity, the higher the P you get. The profit margins, lower profit margins, you get low P. High profit margins is a you get high P because it's a sign that you have a dominant position in your industry. a capital intensive. There's a misspelling mistake here. So if it's a very highly capital intensive, something like I say NTPC, if they want to put up a power plant, they have to invest like maybe 25, 30, 40, 50,000 crores into their business. Vedanta, if you want to put up a new plant, it has to invest like 20, 30, 40, 50,000 crores in this thing. But if it's a simple Jubilant Food who wants to put a store, it probably has to it goes through a franchisee model and it doesn't invest its own money, kind of. And so it's a asset-led model. So where the you are expected to invest money upfront and then the results come afterwards, then market doesn't give you high valuation. Whereas if it is a asset-led business, you get a higher valuation. If it is government owned, you get low P. If it is private sector owned, you get high P. If corporate governance standards are poor, if there's a track record that fund manager had done some fraud and I mean he's shown apathy towards the minority shareholders, then you don't get good valuation. If the corporate governance standards have been consistently high, then you get a high P multiple. Now, why are we talking about this? Is because in the last see because you get the low P ratio stocks traded 10, 15 multiple P multiple and the high P stocks trade at maybe 40 P multiple, 50 P multiple, 60 P multiple. And a small cap index, let's talk about small cap 100 index. In small cap 100 index, every 6 months there's a rebalancing. The lowest 10, 15 stocks, they are thrown out of the index based like to lowest on market capitalization are thrown out of the index, and the largest stocks outside small cap 100 they get included in the small cap index. So what has happened is because these guys are not getting high PE ratio, the low PE valuation, they are slowly they have got thrown out of the index. And the stocks which have a high PE ratio, the structural businesses, asset light model, long growth trends, growth longevity, and high profit margin, those kind of businesses, because they are getting 40p, 50p, their market cap is also very high. So they have risen in the indices, and they have become part of the indices. So in the last 10, 15 years, what has happened is these kind of stocks have kind of gone, the constitution of small cap index has changed from away from these kind of stocks to these kind of more, and there are more and more high P stocks now in the index. So because of this, what has happened is that uh, because of this, it is not fair to really look at the valuations like the chart that we saw here, right? That is not fair to look at that chart. So this chart we saw at the beginning, this is not a fair, this is not a good chart. It doesn't give us a good. It is not fair to compare this valuation, and this valuation, because the constitution of the index has changed dramatically. Because the constitution of the index has changed dramatically, it is not fair to look at this, compare this valuation. This is exactly why we changed our view. The constitution of the index itself has changed, and the interest rates also have come down. Because of interest rates coming down, you can assign a higher P ratio for for the same stock. And then another thing which is underway is that in the last 10 years, the debt to equity for small cap has come down from 1.6 to zero point 0.3. So, for example, you have a 1 crore net worth, 1.6 times debt to equity is equivalent of saying, say, you have a 1 crore net worth, but you have a loan of 1.6 crores, 1 crore 60 lakhs, and you have to pay interest on 1 crore 60 lakhs loan with a 1 crore net worth. So, it was quite stretched. So in the last 10 years, on a consistent basis, they have reduced the debt on the balance sheet, and now it is just zero point 0.3, which is very, very bigger, and it is one of the lowest in history. Not one of the lowest, it is the lowest in history of corporate India. They have never been so deleveraged, and the financial situation for corporate has never been so good. So when you have very high debt in your so if, whenever like you have a very large home loan EMI to pay, you have some car loan EMI to pay, then you are left with very less money to spend on other things, and your finances can go haywire if there's some you miss salary for XYZ reason. Then your finances can go haywire. But if there's no loan, right? If there's no loan, then your finances are very stable. The same thing has happened for small caps. So 10 years back, because the loan was so heavy, so 2 3%, 5% change in the top line could result into a significant change fluctuation in the bottom line. Top line, matlab, if sales went down by 5%, 6%, the profitability went down by maybe 25, 30, 40% because the interest cost was going to be same, but the top line used to reduce. So now, because the interest cost has completely vanished, the profitability has become very steady. Profitability has become steady. The fluctuation has reduced quite significantly because businesses are steady. So that is what I'm saying. Because of this, also business have become quite stable. Some of the highly cyclical business also have become very what do you say, very uh, uh, steady, because see, this is metals. It had 4.32 times debt to equity. From there it has come down to 0.24 times. Something like materials, it had a debt to equity of 1.3 times. It has come down to zero point 0.1 times. Now something like energy had a debt to equity of 4.64 times. From there it has come down to 0.45 times. Something like real estate, it had a debt to equity of 1.5 times. It has come down to 0.39 times. So even the cyclical industries, no, they have also reduced their debt. Consistently they have reduced their debt. So that is why across the board businesses have become very steady. The index constitution has become steady. This is a query that I ran. This is a query I ran in Gemini Deep Research. I wanted to check how the constitution for the index has changed, and whether my assumption about the change in the constitution of index is accurate or not. The query I ran was, I want to analyze how the sectoral constitution of Nifty Small Cap 100 index has changed every year over last 15 years. I want to understand whether the number of stocks, secular business in Nifty Small Cap 100 index is increasing, decreasing, or remaining the same. The conclusion was that the qualitative evidence strongly supports an increasing trend in the representation of secular business within the index over last 15 years. The shift is direct reflection of India's evolving economic structure, characterized by a move towards more innovation driven and consumption led growth models. The inferred increased tilt towards secular business within Nifty Small Cap 100 suggests that India's economic growth is becoming more diversified, resilient, and driven by structural long-term factors rather than solely dependent on cyclical booms. As economy matures, their growth drivers typically transition from reliance on basic manufacturing, commodities, and purely cyclical industries towards more advanced, innovation-led, and service-oriented sectors. So this also is suggesting the same thing, that the constitution of index, small cap index, has changed for better, and the quality of stocks, the average mid cap or a small cap stock in an index 10 years back and average mid cap small cap stock today, it's vastly different. Okay, this is another data which is talking about the growth has become very broad based. The number of companies reporting 10% revenue growth and 10% profit growth like it has gone up quite sharply in the last few years. This is also because, as I said, this is also because uh, the quality of business has improved. The constitution of businesses or constitution of the index, the secular businesses in the small cap and mid cap index has continuously gone up, which is why many companies are reporting high double digit growth. So more than 50% companies are reporting double digit growth for the last 4 on a trot. So this is a very encouraging sign. So fund managers got a very broad set of companies, and the market valuation again have to be looked at in context of this. Ki the growth is itself is very broad based, and the growth is very high as compared to what it was in the past. Another big change which has happened is that the mid cap, small cap share in the overall profit pool is one of the highest in 20 years. This is data from 2004 to 2025, and this data talks about share of top companies by net profit as a percentage of market's net profit trailing 4 quarters. So top companies contribution, which used to be between 40% to 50%, on an average it used to be like 45%. From there it is now like something close to 30%, 31% approximately. So basically, other way to say look at this is that the broader market contribution in the profit pool of the overall market has gone up by close to from an average of 55% to now 70%. So they are contributing because the reason why this has gone up is because they are growing faster than the larger companies. The mid cap and small cap are growing faster than mid cap, the larger companies. That is why their share has kind of gone up continuously. This is another data. In the Q4 earnings, Nifty price growth was only 3%. Nifty 100 PAT growth was only 7%, so this is large cap. But mid cap PAT growth is 28% and small cap PAT growth is 18%. So, even if the indices have not done well, the underlying mid cap and small cap profit growth has been quite healthy. Now, if you look at the future growth trend, I mean, the future earning projections, we have to take it with a pinch of salt. Not many people are able to get it right on an accurate basis. But financial year 26 and 27, mid cap earning growth is expected to be 25 and 19%. Small cap earning growth is expected to be 20% and 16%. And large cap Nifty earning growth is expected to be 13% and 12%. So, as you can see, the earning growth for mid cap and small cap is estimated to be higher than what it is for Nifty 50. So again, I mean the valuation have to be looked at in this context. Market will not the earning just because something is trading at 40p, 50p, it is not going to come down. We have to take into account the quality of business which is there. You have to take into account the quality of the balance sheet which is there. You have to take into account the longevity of growth. You have to take into account the next 2 3 year growth estimates or growth expectations from the stocks or stock markets. So in that context, the just because it is trading higher in compared to history, it doesn't mean that it is going to come down. The market is going to come down. So that is something that we need to. That is the biggest takeaway that we need to have at this point of time. Ki just because like there are some very marquee fund managers who are sitting on a lot of cash because the market is they think the market is looking overvalued in context of historic valuation multiples. Some people are sitting 25%, 15% cash. Somebody had made a statement in February. A PMS manager, very famous guy, he was sitting on 80%, 90% cash. So those are ludicrous claims. Actually, I'm giving you a context or I'm giving you the perspective to look at the market valuations. Now let us look at the liquidity part of it. Liquidity, this is again, misinterpreted it last year when I had shared this chart with some of you. So promoters had sold something like 5 lakh crores from April 2022 to last year sometime 2024. And in 2025 also they have sold something like 70,000 crores. So with like close to 5.5 lakh crores, promoters have sold something like 5.5 lakh crores. But so we'll again relook at this chart. But the interpretation of this chart, probably one interpretation of this chart could be already a lot of selling has already happened. So chances of that there'll be a continued selling is probably low. So promoter selling somewhere some kind of a exhaustion is going to happen. IPOs and all will keep coming, but like big selling sometime somewhere broad based promoter selling probably is going to abate in the coming few years is my opinion. In the last 3 out of 4 years, FIs have been sellers. The chart on the left, right, this is talking about the FI sell position. It is cyclical, and right now in the from September to March, they sold some 15 $16 billion. So for 16, $17 billion, something like that. So it is one of the highest in 10 years. And when the last time that they came back here, they had there was an inflow of about 1 lakh 76 thousand dollars. So something like 2 lakh crores actually came in the Indian market. So what I'm trying to say is ki FII selling is also probably coming to an exhaustion. No, I mean FII selling is not coming to exhaustion just from short-term point of view, probably from even a longer trend. Last 10 years they have been selling the Indian markets. I think we are very close to some kind of a turning point. Why I think so is because of the next slide. See, India doesn't get the money through India dedicated fund. Like FIs do not invest in India specific fund. India gets money through emerging market fund. Emerging market fund. Emerging market funds have been underweight on India for we get money from Asia ex Japan fund. So if you see, India has been one of the biggest underweight for both Asia ex Japan and emerging market fund. So if India's weight say emerging market fund is say 17%, the fund managers in holding emerging markets are investing only 12% in the Indian market. So they have allocation of 12% to India. So sometime in the next, see, and what has happened is India has done extremely well, and the countries where they have invested, they have not done well. So now there is a theory. Now one of the two things is going to happen. Either these countries like Malaysia, Thailand, Philippines, China, Korea, etc., they will do well in the next 1 2 years, and the valuation will be relative valuation of India will again become reasonable. Or the fund manager will somewhere give up on this thing, and they'll probably throw in the towel, and they'll come to India, and they'll start investing in India. So what I'm saying to say is a lot of money, if this 12% becomes 17% again, 12% allocation in emerging market becomes 17%. So that 5% itself is going to be huge, billions of dollars of inflow, because these funds hold hundreds of billions of dollars of fund in them. So when that inflow starts, the FI is a good chance that FI selling is probably over, and sometime in the next 2 3 years, we could see a quite significant turnaround in the FII inflows, in my opinion. Now, this is the last another slide on the summary of what has happened in the inflows, liquidity, so to say, for from stock market point of view. Promoters, if you see, there's a lot of hue and cry about promoters selling out, but if you see in last 10 years, they have sold 3% of from 52%, 52.1, they've gone down to 49.5. So it is only 6% selling. In the last 3 years, what we looked at from March 2022, where the stake has come down from 51% to 49.5. So the stake has actually gone down by only 3%. 3%. Now, in last 10 years, right? The last 10 years, there's been a huge rally in every stock. All company stocks have gone up like 5 times, 10 times, 20 times, 50 times. And so after going up so much, why not take out some profit, or why not take some money off the table? That is how they are looking at it. That is how we also should look at it. Some might be selling big money, but at the aggregate, if you look at it, it's not a very big number. They have मतलब पूरा मलाई सिर्फ मलाई निकाल के ले रहे हो पूरा 5 साल के बाद, द काइंड ऑफ वेल्थ दे हैव क्रिएटेड, उन्होंने सिर्फ मलाई निकाला है, ऐसा नहीं कि पूरा माल बेच के निकल रहे हो. So they're not bearish. It is a misinterpretation. Think FIs are selling, so it is very bad or something like that. FIs on the other hand, they have sold close to 20% of their stake. From 22.8%, they have come down to 18.8. तो पिछले 10 साल में उन्होंने बहुत माल बेचा है. आई थिंक लॉट ऑफ फंड मैनेजर्स हैव सोल्ड, मतलब बहुत सारे जो शॉर्ट टर्म वाले थे वो निकल गए जिसको निकलना है. यहाँ पे भी आई थिंक विल सी अ एग्जॉशन ऑफ सेलिंग, एंड एज आई सेड कि sometime in the next 2 3 years, आई बिलीव FIs will come back, and they'll come back in a big way. एंड FIs अगर आते तो वो बहुत बड़ा पैसा लगाते. एंड मेरे ख्याल से आप देखो तो SIP कितना भी पैसा आया ना, तो भी जब FIs ने बेचा तो भी मार्केट गिरा था. और जब FI ने खरीदा तो 2023 में, तो मार्केट में रिलेंटलेस रैली आई थी. तो FIs मूव द मार्केट. तो FIs का जब पैसा आएगा तो मार्केट में बहुत बड़ी रैली आएगी. DIS, मतलब म्यूचुअल फंड एंड इंश्योरेंस कंपनीज आर बिकमिंग पॉपुलर टूल फॉर इन्वेस्टर्स. वहाँ पे बहुत पैसा आ रहा है. एंड now DIS are holding bigger stake in the market than FIS now. 19.2% versus 18.8 for FIS. SIP book has become a very popular tool of 26,000. This is a slightly old data, but recent numbers are some last month 26,000 crores of SIP came in the markets. Now somebody was saying that because market has gone up because SIP flow is coming and so on and so forth. But SIP flow was coming in this September, October, November, December, January, February, and March also. When market went down, that time also we were getting 25,000 crores of SIP flow. In fact, they were selling, the net flow was much lower than what it was at the market top. So it is misinterpretation. People are just defying their own wrong calls by telling that the money market is going up just because of SIP flows, 25,000 crores. And it matters. I'm not saying it doesn't matter, but then SIP flows were coming in Jan, Feb, March also. No, when market was going down also, that time the SIP flows were 25,000 crores. It did not go down at all. So I don't know. In fact, there were cancellation and SIP net sales were much lower in Jan, Feb, March. So summary of liquidity is that there'll be something like 3 lakh crores of monthly annual SIP flow. EPFO invests something like 50 to 60,000 crores. Fund managers are sitting on more than 2 lakh crores of cash. Balance Advantage Fund have more than 1 lakh crores of cash which they can deploy if the market goes down. So there's close to 7 lakh crores of liquidity with just mutual funds. Now imagine what happens when FIs come back to India. जस्ट इमेजिन व्हाट विल हैपन सो मार्केट नीचे जाने का तो सवाल नहीं है बहुत बड़ा करेक्शन आने का स्कोप ही नहीं लग रहा मुझे तो एंड इफ द फ्लोज टर्न राइट द मार्केट कैन सरप्राइज ऑन द अपसाइड इन माय ओपिनियन. Okay, so that is about the micro or changes which is happening at the particularly I wanted to discuss about the small caps. So now let us dwell into this debate about investing in large caps is good or small caps. So large caps are matured businesses with steady growth. Volatility is lower because there is an inverse correlation between Nifty IT and Bank Nifty. But the problem with large caps is that they are concentrated in six sectors: banks, IT, pharma, FMCG, automobile, and telecom. These six sectors constitute something like 70-75% of the entire large cap universe. Whereas small caps are more volatile than large cap, but the variety of sectors and themes in small cap is much higher than large cap. Small cap has got more than 60 sectors with very unique business models, like something like Office or something like Ethos or something like Dreamfolks, very unique business models. In last 5 years, there have been 230, more than 230 IPOs in the listed space, not including SME IPOs. Out of this, 80% of the IPOs were small cap. Every year we'll see 30 to 50 IPOs, and all of the IPOs that come, they are also 75-80% of the IPOs are going to be small cap. In next 5 years, we're going like more than 50 unicorns are going to get listed, and most of them will be again small caps. So when small cap is not as risky as we think it is, just because the past we have witnessed volatility in small cap, we should not be worried about it because a small cap fund manager has got a much more leeway to create a portfolio. He can create a portfolio from a much wider set of stocks and sectors. If say chemicals doesn't do well, real estate does well. If defense does not do well, maybe building material does well. If something like metals does not do well, something like say textile does well. So there are many varieties and sector themes that he can play, and he can create a good well diversified portfolio which can generate decent returns over medium to long term, even if the volatility is slightly higher than what it is in large caps. So I believe small caps is a must have in the portfolio. Everybody should have at least 20 to 40% allocation to small caps. And I am more bullish on small cap as compared to mid cap because small cap has a much wider universe. A mid cap universe is only 150 companies. As compared to that, anything beyond 250 is small cap. So a typical small cap fund manager has a investable universe of about 500 to 600 stocks, and that is increasing with the passing day because as more and more companies get listed, that number is continuously increasing. I think ki small cap. I prefer small caps over mid cap. And I believe कि small cap should be as allocation should be as high as it is for the large caps. This is the same data which I was talking about कि मतलब you have wide different sector allocation. In the last 5 years, investment theme has done very well. When I talk about investment theme, I'm talking about capital goods, defense, railways, infrastructure, real estate builders. All of them have done extremely well. Now I believe कि next few years as compared to consumption theme, I believe कि the capex cycle is just starting. So in next few 5 years we'll see capex cycle happening. But in spite of that, the consumption, I believe consumption theme will do better than investment theme because value is like if you look at the expensive part in the market, they are all most of them are in the investment theme. Whereas consumption theme has been through a lot of time correction. This is India's per capita, not GDP actually, this is per capita income. This is how it has grown in the last 20 years. So historically, if you look at the countries that have become from developing nation, they have gone to developed nation. The moment they have crossed the per capita GDP of $200, the discretionary spending has gone through the roof. Be it Japan in 60s, 70s, be it Korea in the 80s, 90s, be it China in the last 10, 20 years, or be it the Thailand, Malaysia, tiger economies in the 80s, 90s. So when you up to $2,000, you people usually spend on basic necessities like roti, kapda, makan. Once that is done, then the discretionary spending happens. Discretionary spending, may even housing is also there, entertainment, travel, education, healthcare, all of that is included in discretionary spending. Now, what is the interesting part is that today the per capita income for India is about 300 and $3,200. In the next 5 years, it is expected to go to close to $5,000. In another 10 years, it is expected to go to something close to $8,000. These numbers can be slightly here and there, estimates can go wrong. But what is interesting to note is that the discretionary spending, this blue line is spending on basic necessities, and red is the discretionary spending. So discretionary spending in next 5 years is expected to go up almost 2.5 times, and in next 10 years it is probably going to go up by another 4 to 5 times. So the turnover or the opportunity set for companies that operate in discretionary spending is just massive. They say that there are three Indias in India. One India is similar to Mexico, which is called as consuming class. There are 3 to 4 crore households in this, and their average per capita income is $15,000. There's another India which is similar to Indonesia, which is called as aspirant class. Here there are 8 crore households, and their per capita income is $3,000. And then there's another India which is unmonetized asset class, which is similar to sub-Saharan Africa. There are 23 million, 22 crore households, and their per capita income is about $1,500. So, where do they spend money? The unmonetized class lives in a basic kacha houses, rented house, small homes. Once you move to aspiring class, you buy rented apartments, or buy on EMI, buy houses on EMI, own homes in suburbs. Once you go to consumer class, you buy luxury homes, gated communities, second homes. Food and grocery, local essential brand, mix of branded organic import clothing. Here you unmonetized class uses budget brands, aspiring class uses some fast fashion, consumer class goes for designer brand fashion label. Healthcare may class goes to government hospital, aspiring class has insurance and goes to private hospital, and consumer class goes to private hospital and takes preventive health packages. Transport, the unmonetized class uses public transport. Aspiring classes buys car on EMI and occasionally takes flights. Consuming class usually takes flights, and they drive luxury cars. They occasionally take a business class thing also. So what I'm saying is that more and more people will move from unmonetized class to aspiring class to consuming class. So all the companies which operate in these segments, they're going to witness massive boom in the next 5 to 10 years. Huge. Like their turnovers are going to go up like 3 times, 5 times, 10 times. So that is the kind of growth that we're going to witness. It's going to be an explosion of discretionary consumption, in my opinion. The long-term structural drivers for consumption is nuclearization of family. People are moving from small town to big town. Even in big town, the kids are moving out of the parents' house. And when you build a new house, or you move to a new house or new city, you buy all stuff new, right from TV, home appliances, kitchen equipment, or car or bike or whatever. So all of that gets multiplied. Penetration is increasing. So something like AC penetration is only 12-13%. Washing machine penetration is like 30-40%. Television penetration is like maybe 70-80%. So that penetration itself is increasing. Unorganized to organized shift is happening. So people were used to from unbranded stuff, they're buying branded stuff. Then premiumization. Tiger glucose biscuits, say people are going to Good Day biscuit. People are shifting from say bike to car, hatchback to SUV. People are from 3 star hotel to 4 star, 5 star hotels. from a two-bedroom house to three-bedroom house, like that. So that premiumization also is a very big trend. India is a very aspirational kind of a country. So because of that, all the social media also is driving that trend of aspiration. So consumption, I think, is going to do well. I think this we had discussed. I had shared it on WhatsApp broadcast. GCC say some people are saying कि AI is going to have impact on the IT employment, but GCC employment is expected to rise from 17 lakh to 30 lakh people. Just to put in context, IT sector employs only 54 lakh people. In that context, this 13 lakhs is huge, and the salaries that GCC pay are probably much higher than what IT services company pays. So that is going to be there. There is some 1 lakh crore worth of tax benefit due to some tax exemptions up to income of 1 at 12 lakh rupees. Eighth pay commission hikes are coming next year, about 2.5 lakh crores to 3.5 lakh crores per annum, and increment in salaries is going to happen. Defense and electronic exports are employing hundreds and thousands of people now. Hundreds of, not hundreds, like thousands of people. One factory probably employs 30, 40, 50, 60,000 people. A lot of them are in the south of India. Defense export is still growing, I think, but it is going to reach to that level in the next few years. So these were heretofore untouched industries. So they have started to employ a few lakh people. The textile industries of fortune are reviving because what is happening in Bangladesh, and it doesn't look like Bangladesh is matlab going to back to normalcy in a hurry. And we are reaching a fair trade agreement, free trade after in so many years. First time we are going to do free trade agreement with some of the biggest countries. Like we've done a free trade agreement with UK. Now we are expected to sign a free trade agreement with US, and by the end of this year, we'll have a free trade agreement with Europe also. All of this will be good for textile industry. 4.5 crore people are employed in textile industry. So a lot of these people will be lifted out of poverty. uh, 6 crore, 7 crore people are employed in tourism industry. We all know what kind of boom is happening in tourism industry, and all the tourist cities or centers are in particularly in backward states or Bimaru states, so to say, like UP, Himachal Pradesh, MP, Uttarakhand, Rajasthan. So a lot of the people from here are also getting lifted out of poverty. And once you get lifted out of poverty, usually what people do is from kacha makan, they go to pakka makan. They'll buy a two-wheeler, they'll buy a fridge, washing machine, those kind of home appliances. So demand for all of that is also going to go up. Women workforce participation is increasing. Only 15% women work in India. That number is continuously rising. This number is like 50% for developed nation and 66, 67% for America. And wealth effect, right? Last 5 years have been phenomenal for everybody. Gold prices have gone up 3 times, property prices have gone up, and the stock market has gone up like 4 to 5 times in last 5, 6 years. So because of that, everybody's net worth has swelled. When your financial situation improves, you feel good about your financial situation. Yeah, there is a tendency for people to go out and spend money. So because of wealth effect also, I think there'll be a consumption boom in India. Short-term view is that, see, this is the EBITDA for Nifty 500 X BFSI. So you can see here there was a big slack between Q1 of 2025, Q2 of 2025, and Q3 of 2025. The earning growth ex BFSI and ex oil and gas was literally low single digit, 2%, -5%, and 7%. Now, why it is important is that this is going to be the base for the next 3 quarters. You understand what I'm saying? Ki next 3 quarter base is literally like average 3% EBITDA growth. Average 3%. So on that base, it is not unrealistic to expect that we'll get a 12-15% growth in large caps and maybe higher, more than that kind of earning growth in mid cap and small cap. So just on the base effect itself, we should be getting a good growth. That is also one of the reason why we turned very bullish in February, March, because I knew the base effect is going to come into picture in the next 4 quarters. So the another question that everybody's on everybody's mind is what happens to the if that Iran thing accentuate. So this is a tweet. I think everybody follow, a lot of us follow this guy Sahil Kapoor. He says कि for every $10 more increase in crude oil, our trade deficit goes up by 10 to 15, 10 to $12 billion, and in CPI inflation goes up by 40 to $50 billion. Now, for quite some time, the oil prices anyway were about 70, 75. Today also they are at about 77, 78 or something like that. If they cross 80, then there is some kind of pinch. It can have some pinch. It is not like very big. Some kind of pinch it will have, and it's not very substantial because our inflation is at below 3%. Even if it like goes up by 1%, 2%, it doesn't really matter. It is still in 5% kind of a zone. And chances of say Iran manufacture or Iran supplies, not manufactures actually, it extracts and supplies some 4 lakh oil barrels per day, which is close to 4% of the global supply. So 4% for oil is a or for a commodity like oil is a big number, but that number can easily be plugged because a lot of OPEC plus countries, they're controlling their production. So to plug in that gap, they can increase the production by 4 lakh barrels a day. And even if there is a spike for a few days or a few weeks above $80 or $90, it is not going to last. It is unlikely that we're going to see a sustained trend of $100, $120, something like that. It is highly unlikely that we're going to see anything like that, in my opinion. So any correction or anything that happens, it is a opportunity, in my opinion. One trend I wanted to, it's not a short-term trend. I probably shouldn't have put it in this slide. I should have put it in the previous slides. But one trend I'm very bullish on from a 3 year perspective, one big trend, okay, is that Bank Nifty. This is a Bank Nifty chart for last uh, 15, 17 years. So I believe this trend line is going to get broken, and I believe ki this breakout will be like huge breakout, something similar to what happened to Larsen and Toubro here. Larsen and Toubro, when it broke out after a very large this thing, something similar chart when it broke out in 22, 23. There was a 2x move in very short period of time, say 12, 15 months. The stock went up more than 2x. I see this same prospect for Bank Nifty. I think in the next 3 years, one of the year it is going to double. I don't know whether it's going to be in 20, 25, 26 or like 26, 27. I don't know when it is going to happen. But in next 3 years, Bank Nifty is going to be the leading index for the market, and it's going to take the market higher. Even if the other sectors do not perform, bank is going to really pull the indices higher. There's a lot of margin of safety here, and everybody has got a lot of allocation to banks because banks are highest weight in indices. All the mutual funds have like 20, 30% allocation to uh, banks. So I'm very, very bullish on banks. I think this is a big trend which is going to my this is my gut feeling it's going to happen in next 2 to 3 years time. Now we're talking about the very short term. These are the number of stocks above their 200 number of stocks in Nifty 500 index, which are above their 200-day moving average, respective 200-day moving average. So here in May 2020, only 6-7% of the stocks were above their 200-day moving average, and here more than 80-85% of the stocks were in above their 200-day moving average. The more number of stocks are above their 200 average, it's a sign of a strong market. The less number of stocks are there, it's a sign of a weak market. Typically, it moves in a cycle, right? So some kind of a watermark for a bull bear cycle, or a threshold mark for a bull bear cycle is this 50 marks. When more than half the stocks are trading about 200 moving average, that is a sign that we are in a bull market, and when it trades below 50, then it's a sign that we are in a bear market. If you remember, this is something which happened in 2022. There was a rally, and then it kind of fizzled out here, and it there was another 6 8 months kind of a consolidation which happened. So we're in that no man's zone. Whether it comes down here again, and we have a 3 to 6 months kind of consolidation, or it moves on ahead and it goes up again. That is something that we have to see. But I lean on the bullish side. I believe the market is going to go up. It's not going to come down again, in my opinion. And we are not probably going to see even a range bound market. We are going to see a bull market. This is another, now this is a very short term view. This is net FI longs and net FI short position. If you see in January of 2025 also, FI short positions were something like 85, 86%. Last week they had reached like FI shorts were almost 90% of the overall thing, only 10% longs. So typically when the positioning is so extreme, in the next 3 to 5 weeks, market forms a major bottom. But between that next 3 to 5 weeks, what can happen is very difficult to tell. It's possible that like they pull down the market by 4 or 5%, and then they do the profit booking and they turn. Typically, that turn usually happens around the last Thursday of every month. So it could be this Thursday, which is going to come like this month's expiry last day, or it could be the next month's expiry. I don't know when it is going to happen, but in the next 4 weeks, in my opinion, or it could be this month also, this week also, market is going to form a durable bottom, and it is probably going to go up. Max downside from here is maybe 4 to 5% on Nifty, maybe something similar 6 7%, 5 6%. And small cap, beyond that, I do not think there is a big downside which is going to happen in the market. This is a quote that I share with our clients on a regular basis. Bull markets are born on pessimism, they grow on skepticism, mature on optimism, and die on euphoria. So we are still in that phase of skepticism. Everybody is worried how the market is going up, valuations is high, this is happening, that is happening, why is market going up, earning growth. So all kind of reason people are still worried about everything, all the small things they're getting worried. So it's a sign that we are in a skepticism phase, and we are probably not even halfway in the bull market. We have a we have a long way to go in this bull market. You should not expect 20% kind of earning growth or 20% kind of portfolio returns in the next 3 to 5 years, but you should still make a decent um, 12 15% kind of returns. I think it's a pretty good chance we'll make that kind of returns in next 3 to 5 years. So this is the last slide in the context of what is happening right now. So okay, there's something called as shakeout. Shakeout is a situation in which many investors exit their position in a stock or a market segment at the same time, often at a loss. Shakeout usually is caused by uncertain or bad news. It is usually caused by uncertain or bad news circulating around a particular security or a industry. Shakeout can be quite variable in duration, but they are usually sharp in terms of amount lost from recent high. A shakeout can also be referred to as strong companies in industry using their capital. So what I'm trying to say is कि, skepticism phase that we spoke about, no, it is characterized by this kind of shakeouts. Skepticism phase is characterized by shakeout, and some of the shakeouts that I can remember are what happened after Brexit happened, what happened after demonetization was announced, and what happened after second wave of COVID hit in March of 2021. So all of those were examples of shakeout. So what is happening right now in Iran, whatever, war, so all of that is either style of it's trying to unnerve you, but it is not going to have any significant impact, in my opinion. And we should look at it as a shakeout more than anything else, and we should be willing to invest in the markets, in my opinion. So this is what I end my presentation here. I took quite some time. Yeah, it's almost 1 hour I took. So we'll open the floor for question and answer from here on.